Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. There are so many sectors of the economy that are being impacted by the current COVID-19 outbreak. On today's show, we're going to look at the hotel industry. And last week, Colliers International had a private webinar for its clients focused on the state of the hotel industry. In the middle of March, March 14th, hotel occupancy had fallen to 24%. By March 21st, occupancy was 21%, and now in April, hotel occupancy across North America is below 10%. Now, these types of numbers are absolutely devastating. There's no comparable period in history that shows numbers anywhere close to this. During SARS in 2003, the lowest occupancy was around 42%. We saw a 10.9% reduction in REVPAR during the financial crisis, and in the aftermath of the 2001 terrorist attacks, REVPAR fell only 2%. Most hotel groups have started to prepare in the first week of March, a full 5 weeks after the China lockdown. So they, in some respects, were a little bit slow to react. But a few hotel groups had already started planning for a business slowdown when occupancies had started to fall in Q4 of 2019. But all of the planning focused on a reduction along the lines of what had been observed in previous economic downturns. Many of the hotel groups had started to communicate with lenders in the past 2 weeks to keep them up to date on the state of their business. Majority of institutions have been offering 3 to 6 month interest-only concessions. That means they've been allowed to put off their principal payments until a later point in time. Number one goal was to minimize the damage and to maintain liquidity. That meant talking to lenders, negotiating with suppliers, negotiating property tax deferrals, renegotiating fixed-price contracts, cable TV suppliers, and so on. At the moment, there are no government programs to help hotels yet. The entire industry is waiting to see if they're going to be forthcoming in the near future. Some hotels are looking at 2020 as a bit of a write-off year, and one perspective when it comes to hotel valuation is that many hotels will lose a year of net income. At current cap rates, a complete loss of a year of income could translate into a 5% reduction in value as long as the hotel is able to survive that year. There's a lot of pent-up demand for events. Weddings scheduled for the spring are being rescheduled for the fall. Hotel rates, oddly, are not falling in today's environment. And the reason for that is that hotel rate won't stimulate demand, so there's no reason to drop the rate. The combination of property tax deferrals, loan principal deferrals, government wage subsidies, some amount of workforce reduction, capital project deferrals. Hotel owners on the panel seem to feel that they could weather this storm for a period of time. The owners are hoping to be able to reopen once the wage subsidy is in place, which will mean a very low level of occupancy, perhaps in the range of 10% until we get into a rebuilding phase. Hotels are reaching out right now to healthcare workers who need alternate accommodations to protect their families from possible infection. Some hotels have reached out to hospitals to provide accommodations to patients as overflow for hospitals. There's some scattered demand existing for airline crews and for repatriation quarantines. About 2/3 of the lenders surveyed are pausing and not looking to write any new deals. The 1/3 that are remaining are definitely changing the dynamics of the debt structure. They're looking for a high degree of financial strength, a high degree of liquidity, and a lot of personal guarantees. One hotel operator who spoke had a construction loan approved in the past 2 weeks with a low loan-to-value ratio. Borrowing in today's environment is much more difficult, and there is definitely a risk premium. Loan rates have increased from about the mid-3s to nearly 5% due to the uncertainty. All of the hotel owners on the panel decided to seek short-term extensions on existing loans and not to seek refinancing in today's environment. One of the hotel operators put the minimal fixed cost of operation at around $1,000 per room. Now, the fixed cost includes heat, power, light, insurance, security, principal, interest, and mortgage. By reducing property taxes and the loan principal for a period of time, that monthly cost for many properties can be brought down something in the range of $650 to $700 a month in fixed cost. So they're planning on making sure they have liquidity to weather this storm and just carry that fixed cost. So how are the hotel owners going to deal with the recovery? It means dealing with lenders, with the brands, and leveraging the loyalty memberships to start marketing to clients that have been clients in the past, with a focus on domestic travelers first, before focusing on international travelers. The short term is focused on cost containment, preservation of capital, and maintaining liquidity. The hotel owners on the panel see a lot of pent-up demand as witnessed by the number of events that were scheduled and are being rescheduled in the fall. That means there's a chance for a V-shaped recovery in the travel industry. Most of the hotel owners had run several scenarios ranging from a fast recovery after a few months, and most of the worst-case scenarios don't see a recovery any later than the fall. All of the major operators on the panel were ensuring they had liquidity to survive until the fall. And when it comes to new hotels, many of the hotel owners, just like in past downturns, see the new supply of hotels being very constrained coming out of the downturn. That has as much to do with availability of materials. For example, 90% of the doorknobs manufactured in the world are coming from China. Building a new hotel or an apartment complex, for example, would require a secure supply chain for many building products, including doorknobs. So the financial model for this year, for many, they're planning on 50% occupancy for the year and a daily rate that's reduced somewhere between 15 to 20% compared with historical norms. And that assumes a 0% occupancy for the next 60 to 90 days. The fact is, none of us really know exactly what's going to happen. We don't know how quickly we'll be returning to traveling, how quickly we'll be returning to hosting events. But this is a perspective on the hospitality industry from some major owners and operators of major brand hotels. As you think about that, have an awesome rest of your day. Go make some great things happen. I'll talk to you again tomorrow.